morning, everybody. Thanks for joining in. And today, what we have is a surprise for you. Amazing speaker, a person who has spent almost 3 decades in the industry, who is known for his open views and, of course, very comfortable talk and pointers which we all carry throughout our journey of our investing or interacting with our partners and clients. Today, we are really pleased to have one special personality, Mr. Swarup Mohanty from Mirae Asset Management. Mr. Mohanty has got almost 30 years of experience in the industry of investing, in mutual funds primarily. He's an PGDBM and BCom honors graduate, and he's been part of this industry who has seen the various ups and downs, whether on regulatory side or market side, everything. Mr. Mohanty is also part of Mutual Fund Advisory Committee of the regulatory SEBI and also the Index Committee of NSE. Mr. Mohanty, apart from being a corporate leader, he is also a very passionate person about music, about instruments related to music, and he enjoys traveling. So we are now going to spend some time and seek wisdom from Mr. Mohanty in next few minutes.
So now one question which I'm sure many of our partners and their clients today they are asking, considering whatever is happening in the global arena, whether it is about war in different markets or different locations, whether it is about some economic activities which are happening in the most developed part of the world, while India on other side is considered to be little insulated or better insulated than many others. So how far this thing is true, and what's your view on that?
I think when you look at the globe, it's a very interesting time. I mean, from leaderships across the globe, the styles of those leaders kind of set the tone for the countries. That's something which is an observation lately. To the broad impact of many events across the world keeps the data of the globe fragile. I mean, one big data which was an unknown, which became known, was the US election, which has a bearing on everybody's lives across the world, because in 2008 Warren Buffett made it very simple for me by saying that the world trades in dollars.
True.
There is no alternative. Okay. Now that leadership, thankfully, is also a pretty known trait. We know what to expect, right? And they are committing a very different kind of trajectory to the world now. They have realized that some of their spendings internally were far larger than what they should be. They want to curtail their internal spending. At the same time, when you look at coming back to the leaderships across the world, every strong leader now wants their country first.
True.
They want to make America greater than what it was. So they will come across and ask for their pound of flesh, possibly from across the world, which has its own implications. At the same time, we have this large country in the form of China, which will not take it lightly and will also flex its own muscles in the world. And to be fair, it has created enough impact and inroads globally to counter and probably flex the muscles. The beauty in this entire environment is, as you rightly pointed out, and it's so great to be in that position, that India is mostly neutral everywhere. And at the same time, make no mistake, the growth prospect of India is secularly known across the world. There is no economy which is not acknowledging the potential of the growth of India. And the best part is we consume our own produce.
True.
Right.
Yeah.
So when you combine all that, what you said is absolutely correct. Our data points are a little different from the rest of the world. Well, we might take 5.4% growth as a slowdown. No other country is growing at 5.5%, right? But we need a growth of 6.5 to 7, or maybe 7.5 to hit our target of 2030, which might see some blips, but on an average should see that growth, which is a clear departure of what's happening in the world.
Right.
So India remains in a sweet spot for the next 8-10 years.
Right.
Beyond that, there could be challenges which are also emerging, which all large economies with large population like us also face. How we tackle them will define the 11th year.
That makes absolute sense. Another angle is about how our central bank reacts to what is happening on the global market.
True.
While consumption wise, while as a inherent the strength of economy that we are into, that is perfect position for India to take it to next level.
True.
But interest rates somewhere or other play a role while they are related to the debt market of it, but equity market is also affected by the interest rate movements. And RBI, our central bank, has not moved the interest rates where many people anticipate and time and again talk about. So what's your view on that? Is it going to be have some negative bearing on the equity market in the coming times for now, if it is sustained?
Anjana, when I started my career, I was very fortunate to have bosses who would tell me that don't try to overthink the central banker and don't try to overthink. They are the smarter people around, and our central bank has demonstrated that over a period of time. Now, when you look at any central bank's main objective is threefold. One is to look at the growth of the country, of course to tackle inflation, and the big part is also somewhere to bring policies which will bring about employment, right? Now, when you look at 2025, all these three factors are under pressure, right? Growth we saw towards the last half of the year started tapering a bit.
Correct.
Now, when you look at the growth of the country post-COVID, it has been one way. Some of the consumption patterns had hit a peak, so a slowdown was, or the urban slowdown was somewhere around the corner. It happened last quarter. When you look at 2024 per se, what is the best part about 2024 from a broad country perspective has been the climate has been good, the monsoons have been good. So the impact that we had in 2023 on bad monsoons on 24 will play out in a better way in 2025. When you look at our inflation or CPI, bulk of it is food. So if food is tackled, our inflation will remain more or less moderate.
Right.
So though the growth might taper, the inflation should be okay. But the bigger issue is now unemployment, that at above 8% does pose a threat from the next 5-10 years perspective. It has to be handled. So when you look at doing that and the country will pursue growth, the dominant thing is to bring down the interest rates. I do expect that to happen, but it will not happen in a very diametrically opposite way to, or a different way from what the Fed would do. It would follow the Fed.
Right.
Now, Fed, if you remember, had indicated a very aggressive rate cut forecast, which is tapering down.
Right.
Similarly, we will taper down, but there will be rate cuts next year. I will not try to preempt, but we as a house, we are looking at 50 basis points in this coming year, which should do well for the broad borrowing, or somebody like me who sits on a home loan, or broad cost of capital of the industry, and should spur some amount of growth.
Correct. So taking one point from this, somewhere our growth has tapered down in last couple of quarters, and if the interest rates come down from here, it should support. Are we in a way expecting that the reversal to the mean, if the last few quarters have not been EPS growth as we desired or expected, in the coming times the reversal would come in and we would see a better earning growth, and effectively our price to earning and P/B ratios and all the technical jargons that we look at would return favorable, and people would again look at equity markets? And
see, there is no reason why people should not look at the equity markets, right? It is the best way of forming or getting back this growth of the country to your own self. I mean, we are the only economy probably positioned to double in the next 8-10 years, and I personally feel the best way to get that growth into your life is through the capital markets. So there is no reason why one should not look at equity markets. Please understand, a very interesting part is that when the markets are not good, they are good for you.
True.
When the markets are great, they are probably not good for you. So our view has been very clear that some amount of normalization in the market was expected, some amount of overbought conditions in the market was there, and those were in select pockets. We do believe, and everybody knows, that the market goes through its own cycles, and that's where we advise investors that you can take your own call on selecting stocks, but leave predicting business cycles to fund managers.
True.
It's always wise to do that. That's where the art of the fund management comes in. So we do see that cycle changing, and some amount of reversal of mean on broad sectors and pockets happening in 2025. We remain constructive of the market.
Right.
If you look at the last 2-3 years, people who were diversified in funds were always on a back seat. Fund returns have come, if I am allowed to say, is by taking an aggressive, what we call active share. I mean, closed pockets, if you over allocate or you take some part in a slightly aggressive manner, returns have come there, which according to us was then changing the risk profile of the product, right? We prefer to remain diversified, and we see that merit coming back in 2025. It is probably back to your basics in 2025. So we don't see the markets in a negative way at all.
Right.
What had run probably may take a backseat, and some new parts will start running is our view.
True. Now one of the most commonly traded commodity is information and data. People have data on their fingertips.
True.
Thanks to internet and of course the availability of various devices. One data which is being talked about today is the market cap of various stocks and companies. The largest company, if in India, at least if you look at the large company or mid company or small company or large cap, mid cap, small cap, as per MFI data, 2019 versus the latest information which is shared by MFI, largest company has almost doubled in market cap, while small company has become, or rather if not exactly the same company, but the top company in the small cap is now 4 times of it. So is it like small cap or mid cap have grown much more faster and they need to come down or they need to slow down, or is it like there is enough juice in this segment which can create extra return?
No, it's an interesting thing because that's learning for me as an individual also, because I've been a very large and mid kind of person in my life. But if you look at India as such, it is one of the largest and the fastest growing public issuance market in the world.
Right.
The last quarter of 2024, we were the highest share of public issuance globally. Right, that does not speak very highly for the rest of the world,
right,
but it does show that lot of promoters now have built businesses capable of enough to go to the market. It does also speak of the growing corporate governance, because once you come to the public market, your data is transparent and you are accountable more than you were when you were not, right? It speaks well for the market. We feel that the Indian markets are finally becoming democratic.
True.
Right? Earlier, if one pocket of the market were to leave, the market would collapse.
True.
Prior to the FI journey dominating the market, the Indian market was dominated by 2 large institutions in India, right?
Yeah.
And the market was in trouble. Those 2 institutions would be called to bail them out.
Yeah.
Last 2 years have been practically one-way FI selling, right? But the other part of the market and domestic investors have held it up.
Right.
Make no mistake, both are important.
True.
Some people might say, okay, will they stake out? No, everybody has to be there. When you look at public issuances, there are more companies being listed in the mid and small category.
Yeah.
So if you want to own the breadth of the market, your broad allocation has to shift more towards mid and small market.
True.
And that's what we call as democratization of the market. At the same time, the liquidity, which always was a concern,
Correct.
our house view was liquidity always remains an issue, is also growing by the day, right? And that will only grow with more and more participation in the market. So when you look at the market pre-COVID and post-COVID, and make no mistake, it is an extremely well-regulated market. The flow of money is accounted for, right? When you look at the framework and the growth of the market, clearly the opportunities are broadening. Hence, the cliched, and when you look at your data, the cliched subject of it being a stock picker's market is what 2025 will become.
Wow.
Not all companies will make money for you, so it will differentiate a lot of fund managers in 2025.
That's music to ears, especially for people who would really would like to have play money invested in the market, not only the grow money part of it. So yeah, I'll just pick one more point, which is around foreign investors and domestic investors or retail investors keeping the market. Now, this is one interesting trend. If we look at last 2 decades in Indian market, possibly the foreign investors used to have 26-20% of the holding, which has come down to below 19%, 18%. So it's not so that they have actually pulled out money, but it's other retail investors have gone up.
Correct.
At the same time, last quarter we saw after 4 or 5 years, we saw foreign investors pulling out money. is it like, they are actually going out of Indian markets now, they are not seeing the enough juice, or is it like, they will come back, or they will of course drive some growth in the market in the coming times?
No, I don't see it as them pulling out, because the MSCI allocation to India still remains intact. But it is, like you say, like we discussed earlier, a big unknown getting known.
Right.
And hence there were opportunities back at home rather than India. And of course, I do suspect the volatility of the rupee also plays a part in that, because for them it is that from a return perspective it does matter. But when such a big thing happens, some amount of money does go back into their haven, and to be fair, their markets in pockets have done phenomenally well.
Right.
Who would have thought that when you look at the Indian mutual fund industry, after so much of analysis, the top fund would become Fang Plus, which we had not thought for when we started then. But that's the impact of that market, and I think smart money has moved back.
That's interesting. Now, something about small cap or mid cap as a one segment of the market.
I think if you read me in 2016 or 17, and this is my personal belief, that India is a mid-cap story.
Wow.
India will perpetually remain a mid-cap story. And as a fund house, we've been broadly riding that story, and we're very fortunate that one of our flagship funds, Mirae Asset Emerging Blue Chip, which is the Mirae Asset Large and Mid-Cap, has practically caught that journey, which is synonymous to our journey.
Right.
But because of the new issuances, and a lot of good companies now being listed more in the smaller mid-cap and the smaller caps, the opportunities for fund managers now broadens into those areas, which was not so before COVID. So the scope, and when you look at this, more often than not, we talk about the stocks within the index. There is a possibility outside the index also.
Correct.
Right? I think that's something which people should track, and the need for an extensive back end for your research is growing by the day. I mean, just not to propagate or sell our fund, but one of the reasons we had stayed away from the small cap was, to grow a good back end before you can launch a fund. It's very easy to launch a fund, but to manage it properly is what a fiduciary role is all about. So we got in Varun, who comes from that part of the market, and then now has built a good back end of a research analyst. We will continue to build that. But without that, going and finding stocks in those part of the market is a little different from what it is in identifying stocks in the large and mid size. So from an Indian opportunity perspective, when you look at the journey from 2025 to 2035, I dare say a lot of new opportunities will exist in the mid and small. Now, each one should cater to their own risk profile, while the mid will give a very solid base to the growth perpetually. I'm sticking my neck out on this one. But don't discount the possibilities of some brilliant stories emerging from the small cap. Earlier, the data of a migration from a small cap to large cap was very small. I think when you look at it from the next 10 years, the possibilities of migration from small to mid will be larger than what it was in the last 15 years.
Right. Just taking one different dimension to small mid. Last 3-4 quarters specifically, some competent authorities in the market or the media publications, they have been communicating that be cautious about mid and small caps specifically. They have been educating people, they have been warning people, whether it was intermediary or the investors both, even to the extent they were inquiring why you bought such segments of the market. So on that note, while it is happening, and a small cap offering or a small cap product, how the timing, what do you say about the timing?
See, I have two sides to this story, Anjaneya, and I can prove it with figures. Money follows performance. Right? If you check, and I'm being very honest about this, when the bulk of the money came in, bulk of the returns were already behind them.
True.
And that is why that proverbial Carl Richards slide, investment return versus investor return.
Correct.
When should you buy? When good companies are available at good prices. And definitely in the last 2-3 years, some good small caps were not available at good prices.
True.
When you are going to buy them, obviously your experience will be very different.
Correct.
It's all about investment experience. Now, if the market's correct, which we are seeing some signs of them, then it becomes the margin of safety to invest becomes better than that time. I do agree with a lot of those commentaries about when you should have bought the fund.
Correct.
Now, and we give it in writing, no? Past returns will not be
That's true.
responsible. So we have absolved ourselves.
Yeah.
Now, investors, after going through all this, should understand this. And then the best time to accumulate is when those companies are not doing well on the stock market prices for some reason. If you can choose them, great, buy them on your own. But especially in the mid and small, I would recommend first get good advisory, especially in that segment, because sometimes the return can it can tempt you to over allocate. Now, allocation makes money, over allocation kills money.
True.
So first get an advisory on how much you should allocate on your risk profile.
Correct.
And that should be left to a professional, especially in this part of the market.
Correct.
Second, on this part, because it's very cyclical in nature, I would prefer a fund over direct stocks.
Completely agree.
So one, your allocation should be very tight, watertight on this, and please don't over allocate based on last few years return. But if the markets start mitigating or reversing to mean, brings some great opportunities for accumulating.
Interesting. Now, when you brought this concept of building portfolio or constructing a portfolio, there are two terms: play money and grow money.
Correct.
Grow is one where you at least you should not compromise on the bare minimum growth that your portfolio should be having. Play money is where you can afford to take risk.
Yeah.
Where would you place a mid and small cap category or a fund? I understand age-wise and various profile-wise it may be different. What should be the allocation for a person? Let's keep it two segments. One, people who are retiring or not post-retirement, or who are accumulating for retirement.
Yeah.
So,
Now see, so person like me who is probably invested in the market when I retire, my profile will be very different, say from my father who was a teacher and he's retiring. Though we would retire at the same age, but the risk profile and our exposure to the markets would be very different. So that one has to segregate. And let's discuss a normal person who is not exposed to the market. I do believe post-retirement, and hence and since our lives are getting longer, it is very important to play money always. Very important. Because as you grow older, and forgive me for saying this, your only true friend is money.
true.
Right? And the need for money as you grow older becomes even more severe. More severe for women, because women will live longer than men. So the play money for women is actually more than what it is for men. Men will die and leave, it's good for them. But women who stay at that age will lead a lot of money. Right? And that's a realization. Sooner it comes, easier it is to plan. And then planning is no rocket science, let me tell you. If you plan it a bit, everything can be done quite easily. People think you need a lot of money. You don't need a lot of money.
Right.
Right? That's point number one. Point number two is, as the markets are getting more and more democratized, as a house, we used to blatantly say to a low risk person, even in their working life, 70-30, 70 large cap, 30 mid and small. That is beginning to migrate from 50 to 50 because of new companies getting listed in the mid and small. Right? There is no mutual fund which is large cap.
Correct.
Right? And when you look at the future of mutual funds, they are an annuity business. Right? For them to become large cap will take some time.
Right.
I'm just giving one example.
Yeah, that's
Right? Hospitals, which are the future. I think one hospital in large cap, rest are all here.
Yeah.
I can go on. But because of that, the proportion of money that you will allocate there will be larger. Hence, I do believe at this moment, it is very important to get back to an advisory mode as you tend towards retirement. This country has two ticking bombs. One is retirement. Second is women investing.
wow.
Both need a lot of, and these are ticking bombs. Only 9% get pension.
True.
Right? And as you grow old, if you don't know, and to be fair to the market, over the last 20-30 years, the distribution and the advisory skills have also developed.
Correct.
And they've become very, very, what can I say, neutral from a product recommendation perspective. Bias is decreasing.
Correct.
And that makes it more customer centric. So please, if you don't know, go to a good advisor and build your portfolio. Once you build your portfolio, the other secret is stay invested. The person who leaves the market loses everything. It's an economy which is going to double.
Correct.
Stay the market. And we can do this discussion every year, and I'll be responsible for this statement.
Wow, that's absolutely a big one. One last word of wisdom or piece of advice for all our partners and investors who are associated with us. What do you suggest, from here on, how they should build portfolio, how they should look at markets, how they should look at this business of being the intermediary between the market and investors?
See, Anjana, I've been making this statement from 2002. Okay, that there is a risk to investing, there is a risk to not investing. Right? There is a risk to investing in India, there is a risk to not investing in India. The risk to not investing in India in these 10 years is substantially large. So understand that. We are very fortunate to be in this country at this period of time. Don't underestimate that, number one. Once you know that, then the rest is easy. Second is all redemptions, unless it is bought to buy another asset class, over the last 20 years have been wrong. Go and check the NAV as per your market timing then, when you had redeemed, and check the NAV now of that fund. And the answer is in front of you. Market timing is futile.
True.
Stay invested. Enjoy this country. Enjoy the compounding of this industry. Make it as simple as possible.
That's amazing.
Okay. For advisors, there is only one rule. What is right for the investor is right for you.
Right.
Make it investor centric. Your wallet share will increase. Don't get restricted to one asset class. We've seen with figures that people who give bigger asset classes or all asset classes tend to get bigger wallet share.
Correct.
You take any distributor above 500 crores of AUM has sold all asset classes. And from 2025 onwards, let's look at a person like me. I've stood up on enough podiums and said equity is the growth asset class. Last 10 years, gold is beating the index. So you don't know.
Correct.
And next 1-2 years, because of the fragility of the debt, for all you know, debt might give you the returns. Right? Last 1 year, today I was seeing the data, last 1 year liquid fund average return as per value is 7.1. That's crazy. And retail investors don't invest because we sell only equity.
Correct.
But if you got that liquid fund or debt, your wallet share would have increased. And hence your chance to own bigger money increases. So sell all asset classes, understand the merits of all assets and build stronger portfolios, but more important, remain invested. The person who leaves the market loses everything.
These two words are amazing. Risk of investing or not. Amazing, sir. I think it's a pleasure having you here, or rather spending time with you and taking your word of wisdom. And I'm sure we are going to have many more such sessions for our partners and our investors, and we'll gain from it.
No, thank you, Anjana. Thank you for doing this. Always such a pleasure doing this.
It's our pleasure. Thank you so much.
And look forward to a great year ahead.
Absolutely. To you too, sir. Thank you so much. So nice.
Yeah.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.